Okay, think about this for a second. Back in 1962, Decca Records turns down the Beatles.
Right. The famous story.
Yeah. Told their manager guitar groups were like, on the way out, no future for them.
Imagine basing your whole investment strategy on that kind of expert opinion.
Exactly. It sounds completely wild now. But, how often do we maybe do something similar with money advice? Accepting these really confident predictions.
All the time. And the consequences there can be, well, a lot more serious than missing out on a band.
Which is why we're doing this deep dive.
Precisely. It really highlights this pattern of confidently incorrect takes, especially in finance.
And guiding us through this is Barry Ritholtz's book, How Not to Invest. Now, Ritholtz isn't just some random commentator. He's chairman and CIO of Ritholtz Wealth Management. Been in the industry a long time.
He's definitely seen a lot.
And his book, which we're looking at excerpts from today, basically argues that, well, a lot of the financial advice we get hammered with.
From TV, from supposedly successful people.
Right. Is actually pretty unreliable. It can even, hurt your finances.
So our mission here is pretty clear, really. We want to help you build up a healthy dose of skepticism.
Yeah, a filter.
Exactly. By digging into Ritholtz's analysis, the idea is you can spot these common pitfalls and hopefully make better, more informed decisions yourself. Understand why so much advice just misses the mark.
Okay, let's jump in. One of the first big ideas from Ritholtz that honestly made me pause was this concept of the illusion of expertise.
Yes.
And something he calls epistemic trespass. What does that actually mean?
Right, so epistemic trespass. It sounds fancy, but the idea is simple. It's when someone who's genuinely brilliant in, say, building widgets.
Or real estate. Maybe.
Or real estate, perfect example, starts holding forth on, infectious diseases or, more relevant here, macroeconomic forecasting.
Stepping outside their lane, basically.
Totally. And the illusion of expertise is when we, the audience, just assume their success in area A automatically makes them an expert in area B, C, and D. Especially something as messy as predicting markets.
And Ritholtz uses that billionaire, Sam Zell, as a case study here.
He does. Zell, an absolute giant in real estate, hugely successful.
No question.
But as the book points out, he publicly predicted a recession, I think it was starting around 2015, repeatedly.
Yeah.
And the big downturn didn't really hit until the pandemic in 2020. In the meantime, stocks and property values actually went up quite a bit.
So the prediction was way off. But the key thing Ritholtz points out isn't just that he was wrong. Everyone's wrong sometimes.
Right. The issue was because he was Sam Zell, billionaire business titan, people gave his economic forecast way too much weight.
That's the halo effect the book mentions, right?
Yeah.
Linked to Thorndike and Rosenzweig.
Exactly that. We see the success, the halo in real estate, and it sort of spills over. We just assume they must be brilliant at predicting the economy, too.
Even though it's a totally different skill set.
Totally different. And Ritholtz's point is crucial. People inappropriately overweighted his economic pronouncements. They might have made bad investment choices based on expertise that just wasn't really there for that specific topic.
Which ties right into his view of, well, the financial media.
Oh, yeah. He describes it as this overwhelming fire hose of speculation and opinion, just relentless.
Sounds about right.
And his argument is, for a long-term investor, most of that noise, you can just ignore it. It's often more about grabbing eyeballs than giving solid, useful advice.
Okay, theme number 2 then. The problem with forecasting itself. Ritholtz brings in that great quote from William Goldman about Hollywood.
Nobody knows anything. Yeah, it's a fantastic quote.
How does that apply here?
Well, Goldman was talking about predicting hit movies, right? Impossible. Ritholtz says, it's pretty much the same deal in finance and investing.
Even with all the data and AI now.
Even with all that. Accurately calling future market moves, picking the next big stock.
Yeah.
It's just incredibly difficult, consistently, anyway.
The book uses John Wick as an example, which I thought was brilliant.
It really is. Keanu Reeves is starring, right. But the first movie was an indie film.
Because?
Because apparently no major Hollywood studio wanted to touch it initially. The experts, the people whose job it is to know what audiences want, they just didn't see the potential.
And now it's, what, a $2 billion franchise?
Over $2 billion. It just goes to show, right? Even the supposed experts in predicting taste can get it spectacularly wrong.
Hindsight makes it look obvious, I guess.
Always. But at the time, Ritholtz points out, they lacked the vision. It's a great reminder of just how much uncertainty there is, even with, as the book says, big data and artificial intelligence.
And this isn't new. He mentions the Beatles again.
Yeah, the Beatles bomb on TV headlines, critics calling them hoarsely incoherent.
And the BlackBerry. That 2007 Fortune cover praising BlackBerry just as the iPhone was about to change everything.
Iconic, isn't it? BlackBerry seemed invincible, then boom, totally different landscape.
It happens again and again. Music, tech, finance.
Exactly. These examples just hammer home how fallible expert predictions can be, even when they seem super confident. Which leads to another sharp point from the book.
Which is?
All forecasting is marketing. Plain and simple.
Ooh, cynical. But maybe true.
Well, think about it. Often the goal isn't really accuracy. It's about getting attention, promoting a service, pushing a narrative, not necessarily giving you the unvarnished truth about the future, which, again, nobody really knows.
Okay, that's a heavy thought. Let's shift to the third big idea. How our own minds, our psychology, can lead us astray. Ritholtz gets into cognitive biases.
Absolutely. This is huge.
Yeah.
He argues our built-in mental shortcuts and emotional reactions are often behind our worst investment mistakes. Understanding them is key.
He talks about denominator blindness. What on earth is that?
Right, denominator blindness. It sounds technical, but it's about how we react to numbers without context.
Okay.
So imagine a headline, Dow plunges 500 points. Sounds terrifying, right?
Yeah,
Panic.
yeah. Sounds
Yeah.
bad.
But wait, is the Dow at 10,000 or 40,000? A 500-point drop is a much, much smaller percentage hit when the overall number, the denominator, is huge.
I see. So we fixate on the 500 points, the scary number, and miss the actual scale of the move.
Precisely. We react to the raw number without the crucial context. And Ritholtz says this can make us freak out about, say, market crashes, which are relatively rare, while we totally ignore things that consistently eat away at our returns, like high fees or trading too much. Those might be way more damaging over time, but they're less dramatic.
That makes sense. What about survivorship bias? That sounds important, too.
Hugely important. Survivorship bias is when we only look at the winners, the survivors, and forget about all the ones that failed.
How does that play out in investing?
Well, think about mutual funds. You see ads for funds with amazing 10-year track records, right?
Sure.
But what you don't see are all the funds that did poorly over those 10 years and were quietly shut down or merged away. They're invisible.
So you only see the successful ones left standing.
Exactly. And it gives you this totally skewed, overly rosy picture of how easy it is to pick a winning fund. You're ignoring all the failures because they've literally disappeared from view. Ritholtz stresses this distorts our perception of the real odds.
And quickly, he also warns about politics messing with our decisions.
Yeah, just a brief mention, but important. Getting way too optimistic just because your party won the election, or doom and gloom because they lost.
Letting emotions or partisanship drive investment strategy.
Right, which is usually a recipe for making irrational choices that have nothing to do with the actual economic or market fundamentals.
Okay, so we've covered quite a bit from Ritholtz. If you had to boil down the main takeaway, what would it be?
I think the core message is be skeptical. Be really skeptical of financial advice, especially when it comes from someone who isn't actually an expert in that specific area, or when it's delivered with absolute unshakable confidence.
Question the source.
Always ask yourself, what's their real expertise? What's their track record? What might be their motivation? Remember that line, all forecasting is marketing.
So the challenge for you, the listener, after hearing all this.
Yeah, the challenge is maybe to reflect a bit. Look back at your own investing. Were there times you maybe acted on iffy advice? Or let fear or greed take over? And then think about how approaching things with a bit more skepticism, focusing more on a solid process rather than just reacting to headlines or predictions, how that might help you make better choices going forward.
Right. So maybe the final thought to leave everyone with is, what are your own blind spots?
Ooh, cool.
Where might you be taking advice at face value without realizing it? What assumptions are you making about who's an expert? Thinking about what you might not know you don't know? That's maybe the first step to smarter, more resilient investing.